Hi everybody, this is Oriana Shea with the Oriana Shea Group, and on Real Talk About Real Estate, today we are going to talk about the interest rates with Chris Fenoglio from Finance of America. Well, welcome, Chris. How you doing?
I'm great. How are you?
I'm good. So Chris is a local reputable lender that we've worked with for a number of years, and I really wanted to pick his brain about the crazy interest rates and what's going on. So Chris, to start with, where are the interest rates today?
That's a great question. I'm going to take this from you.
High tech, folks.
So, interest rates. It's hard to say, hey, what is my rate today without knowing the situation? And I'm going to give you just a quick overview. A conforming loan today, that's your garden variety type of loan, your Fannie Mae, 5-10% down, you're probably looking in the mid 5% ranges. Now, we also have other loans, jumbo loans, right? Those loans tend to have lower interest rates. Those are higher qualified clients. You're putting a larger down payment, higher FICO scores, bigger reserves, and those rates are still in the fours. I know everyone hears that interest rates are 6.875 and the sky's falling. It's 100% not true. So definitely get a second opinion if you hear that out there, because that is not actually the case today.
Okay, great. Well, so I guess the next, logical question is, why are they going up so fast?
That is the question I've been answering for the last, 6 months now, and the word is inflation. And what's going on with inflation is you're seeing inflation. We just saw the numbers come out for May was 8.6%. And what is that? That means the cost of goods are going up 8.6% in a month, which is not true. We know their cost of gas is a lot higher, the cost of food, groceries. If you go back a whole year, things have almost doubled. The only way to fight inflation is you have to make it cost more for everything, and that includes interest rates. And so we are feeling the pain right now with interest rates because the inflation number goes up, interest rates go up. Of course they're going to go up. We have to fight inflation. When we had inflation numbers of less than 1%, you could get an interest rate at 3%. But when you have inflation numbers at 8.6%, you're going to have interest rates in the 5-6 range. Those are coming. So that's kind of why we're seeing all this right now. And it's one word, inflation.
Okay, so that all being said, when do you think the rates are going to start coming down?
I actually know that answer.
You knew the other answers.
So as soon as we see inflation go down, when the numbers of inflation start going down, mortgage rates will start coming down. When? It's tough. I don't know that exact answer. There's a lot of talk about a recession coming. There's a lot of talk about things where Airbnb just came out and said 60% of the people are not booking anymore. They're down 60%. A lot of people are saying people are holding back. And the reality is this. To cure inflation, we can do this. All of us go grab our current bank statement, our credit card statement, look at all the stuff that we spend, highlight in green what you need, highlight in yellow what you don't need, cut it out. We got to cut out spending. Spending is causing this. It's us just living the last 2 years, right? Just everything goes up and we're spending so much money. Once we as America stop spending so much money and we hold back and start saving more, you're going to start seeing interest rates come down again.
Okay, so that leads me to my next question, which I'm going to spring on you as a surprise question. Since the rates are forecasted to eventually start coming back down, what's the best way for people that are in the market right now that want to get into a home to get into a home without necessarily locking into a higher interest rate to wait out the market a little bit until the rates come down? There's products on hand now or available to help buyers get into the market, right? So let's talk about ARMs and how those can be helpful.
Great question. I'm glad you did spring that on me. So, because I am a fan. Yes, in 2007, 8, 9, we saw a massive crash, and that was lending issues. That wasn't because of ARMs. What is an ARM? An ARM is a short-term rate, and we'll talk about that. I'm a big fan of what we call a 10-6 ARM. It's fixed for 10 years, and it's amortized for 30. So for the next 10 years, you're going to have a lower payment, and that rate's fixed for 10 years. Do you know what the likelihood of you keeping that loan for 10 years? It's probably zero. People are going to sell their house. They're going to pay it down. They're probably going to refinance because we do know these are higher rates and this is not sustainable. We are going to see lower rates. Don't know when, hopefully sooner than later.
I just want to end on one point that I want Chris to clarify, because I think when people think of ARMs, they think of interest only. Are ARMs necessarily interest only, or can they be, or can you be making payments towards your principal so that in 5, 7, 10 years when you go to sell or refinance, you've paid down your principal just like you would on a 30-year fixed, right?
Correct. I'll take this from you.
That's it. That's all I want to know.
So, 100% right. ARMs, they do have a feature of interest only. We're not seeing that very often. Most people are wanting an ARM with principal towards it. The interest only, we're seeing that on super jumbo loans. On a regular price point that we're in, most people are paying towards principal every single month, and you can pay extra towards it. And the beauty about an ARM, this is what I do like about it. Let's say you wanted, you're a commission only employee or person, and you got a chunk of change, you got a bonus at the end of the year, and you wanted to apply it towards the principal. You can do that, and it re-amortizes your loan, so you have a lower payment on an ARM. On a 30-year fix, if you do that and do a principal reduction, most of the time you can't re-amortize it. Some lenders allow it and some don't, but on an ARM, it's automatic.
Awesome. And then the ARMs, just last thing, I promise. How much is it really saving them in the interest rate from a 30-year fix to an ARM? Just rough.
Ballpark, probably 3/4 of a point. You're probably seeing an average 30-year fix at 5.5 and an ARM at 4 3/4 today. And so it's a significant.
That's significant in the payment.
On a $600,000 loan amount, that's $500 a month. So that's why we're starting to see buyers go that route.
Awesome. Thank you so much, Chris. I hope this was helpful, guys. As always, please like, subscribe, or comment down below. If you have more questions or if you need help with anything to do with purchasing a home or refinancing, please reach out. We'd love to hear from you. Bye for now.